Good afternoon, ladies and gentlemen, and welcome to the DP Poland PLC trading update for the 6 months ended 30th of June 2021. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll send you an email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Nick Donaldson, Non-Executive Chairman of DP Poland. Good afternoon, sir.
Good afternoon, Mark, and good afternoon, everybody. Thank you very much for making the time to join us. I'm Nick Donaldson. I'm Non-Exec Chairman of DP Poland PLC, and I have been for some years now. And I'm delighted to welcome you all to our first Investor Meet conference call. So given it's our first, do please bear with us. We'll do our absolute best. The aim is for us to speak for about 30 minutes, for a question and answer session thereafter, and we hope to have the whole thing contained within 60 minutes, 1 hour. So the purpose of this meeting is to provide an update on the merger of DPP and Dominion. Back at the time of the announcement of the transaction, the board called it a transformational deal. The deal completed early in calendar 2021. We're still of the view that it's a transformational deal for this business, and I hope that this presentation will show you that. We remain very excited for the outlook of the enlarged group. So I think probably the starting point, because you don't need to hear from me because I'm sort of part of the past, what you need to do is to meet and to hear from the new exec team, the guys in Poland, and also to interact with our largest shareholder. And so if we can go onto the slide with pictures of the four of us, that would be very handy. There we go. Excellent. So I've introduced me, that's my background, but Piotr, if you'd introduce yourself, please.
I'm the CEO of Domino's Pizza Poland. I have joined the board in January this year, and I was previously with Dominion for 20 years. I started as a regional manager responsible for overseeing their 15 restaurant at that time. Next, I was promoted to general director. My responsibility included purchasing, operations, office administration, oversight of IT. And finally, in 2018, I became CEO. I started my career in Carrefour Poland when I was responsible for purchases and price management.
Thanks, Piotr. So that's Piotr, our CEO. Over now to our CFO, Małgorzata Podkanska. Gosia she's better known as that. It's much easier for us Brits to pronounce that name. Gosia, please introduce yourself.
Thank you, Nick. Good afternoon, ladies and gentlemen. My name is Małgorzata Podkańska, and I am a CFO of DP Poland. I've joined DPP in January 2021. Previously, I was a CFO of Dominion for 4 years, and I started my professional career at PricewaterhouseCoopers in audit department. Thank you.
Thanks, Gosia. So, Przemek, if you introduce yourself, and then I think at this point you're going to say a little about the rationale for this deal, and then we're going to go forward from there.
Yeah, thank you, Nick, and very good afternoon to everyone. My name is Przemysław Głębocki, and I joined the board in January this year. I'm also the chairman of the Polish Private Equity Association and the co-managing partner of Accession Capital Partners. ACP is a private equity fund manager operating in Central Eastern Europe for almost 20 years. We invest in growth situations in this part of the world, and we actually capitalize on the convergence of CE to Western Europe. We have completed almost 60 transactions in the region, raising 4 funds from institutional investors. And our third fund is an investor in Domino's Pizza Poland, and previously was investor in Dominion. As Nick said, our third fund is a 45% shareholder in the entity, being the largest shareholder, and me and my colleague represent the fund on the board. The merger of the two companies, this is what also Nick referred to. The merger of the two companies, being Dominium and Domino's Pizza Poland, was always very clear to us. The two companies operated on the same market, targeted the same audience, and offered very similar products. The brands were similar, so the merger of the two companies was the most straightforward combination of pizza restaurants or pizza businesses in the country. And also, it removed the confusion that the customers had anyway. The combined, the appeal of the merger is to create the leader in pizza delivery in Poland, which generates to us a number of synergies that are both on the top line and also on the cost side. The companies were competing with each other, so putting the two businesses under one roof enables us to be much better in pricing, to have more room to maneuver on the sales tactics and also marketing. The two separate teams spent quite some effort on trying to differentiate, to show why one product is better than the other. And now we can use all this effort and money to promote only one brand. And by combination of the two companies, only we can increase the visibility of the brand both in offline on the streets, but also in online when we do not need to compete, for example, for AdWords in Google. There are some obvious synergies that I will comment on maybe later on, but I just wanted to give you an impression of how transformational this deal is. Looking at Warsaw, which is the largest Polish city, we are now the largest pizza delivery business here, which means that our distance to customer is much smaller. The two companies competed with each other. They were one of the largest players here, but now the size doubled, which means that the distance is roughly, well, arithmetically it's half. In practice, our estimates show it's something like 30% smaller, which is quite a major saving for a delivery business. We'll comment on this maybe later on. Before I maybe hand over to Gosia, you will hear today a bit about the statutory accounts. We wanted to comment on those, as you can see those published on our website. We, however, think that this is not that relevant as in other cases. This is mainly for two reasons. 2020 is a year affected by COVID, and secondly, because of the international accounting standards. In 2020, we couldn't show the combined business and audited by auditors. But I don't want to steal the show from Gosia, so I will hand over to Gosia now.
That's great. If I can just say this, I mean, frankly, 2020 is history in effect. What we're much more excited about is talking about the future. So we'll whiz over the historic stuff, but if there are any questions, obviously we will address those. Gosia, over to you.
Nick, once again, good afternoon, ladies and gentlemen. I'd like to say it's a great pleasure for me to comment on the financial performance of DP Poland for the first time as the company's Chief Financial Officer. As Przemek already mentioned, 2020 was marked by challenges of the COVID-19 pandemic, which had a severe impact on the operations and performance of many industries worldwide, including the restaurant and food delivery sectors in Poland. The ability to provide indoor dining services has been restricted by Polish government guidelines twice in 2020. These restrictions have inevitably negatively impacted restaurants' performance. However, in contrast, the full food delivery sector has thrived. The food delivery sector in Poland has grown during the pandemic, and the group, with its short delivery times, contactless payments, and contactless delivery or collection service, has took advantage from this sector's growth despite the unfortunate circumstances. The numbers we present on this slide are statutory accounts pre-reverse acquisition. So please be aware they do not represent the merger impact. System sales growth of 5% is primarily due to the group's delivery operations, taking advantage from the COVID-19 restrictions and the improved food delivery dynamics in Poland. DP Poland's performance in 2020 consistently improved from quarter to quarter, with negative like-for-like growth during the outset of the COVID-19 pandemic to a 12.9% increase in the last quarter of 2020. Revenue increase of 6.9% is a result of buying back sub-franchise stores. In the second half of 2020, we have bought back 7 sub-franchise stores. The increase of loss for the period is a result of specific circumstances referring to minimum wage increase in Poland of 16%, increased scooter maintenance costs as the fleet becomes older and requires more repairs. And additionally, 2020 numbers are impacted by reverse takeover related expenses, which were approximately 1.1 million pounds.
That's great. Thanks, Gosia. Now, if we move forward, we'll give you on our next slide a picture of a consolidation, a pro forma consolidation of the two businesses to give you an idea of the scale of the business. But that's again history. It's more the future we're talking about. But Gosia, back to you, please.
Bring it back to Przemek to tell a few words.
Yeah, I mean, for some of you, this is actually the first time we present the story behind the merger and also what the Dominion was. So very few points here, looking retrospectively. The first point is to connect to what I mentioned before. The merger of the two companies meant doubling scale of the business. You can see that on the top line, both in 2019 and 2020. The second important comment to make is about the profitability. You could see on the previous slide that Domino's Pizza Poland was loss-making in 2019 and 2020. And by combination of the two companies, we immediately get into profits. Just also to clarify, this is a pro forma consolidation, which means the numbers are simply added of the standalone company. So that does not include any synergies, neither on the top line nor on the bottom line, which means cost synergies. When explaining the dynamics of 2020, I think it's an occasion to comment a little bit about the business models. Domino's Pizza Poland was predominantly a delivery business, but Dominion was standing on two legs. One was delivery, the other one was dine-in. The dine-in part of the business was affected by the lockdown measures, as you can imagine, but the loyalty of customers proved to be there, and our customers switched from dine-in to the delivery business. This is why, despite the restaurants being closed, we could deliver only a small decline in the top line dynamic. It had, however, an impact on overall profitability, as delivery business is a bit more expensive than the dine-in because obviously of the delivery cost. The other costs are the same, and the delivery cost being the additional has an impact on profits, and that's why you can see 2020 performance being worse than 2019. However, again, to be noted, this is a transformational deal because from the losses, even in such a difficult year, without any synergies, the business on a consolidated basis became profitable. Maybe the last comment about the loss for the period and adjusted loss. We are not very well, me as a representative of the shareholder, we are not that much concerned about that number because to some extent it is driven by non-cash items, which is depreciation and amortization, and to another extent, it is an impact of the shareholder loans that were in Dominion and were done at a higher cost. This was our private company, so we could decide. And that is non-recurring anymore. So this is why we actually pay attention to the profitability at the EBITDA level. So I think this is all on my end regarding this slide, and also giving you a bit of background to Dominion and how we see that this transaction changed the overview of the entire business. Thank you.
Thanks for that, Przemek. Gosia, is there anything you would like to add on the slide of the pro forma?
Yes, thank you, Przemek, for making this introduction. What I would like to say is that the acquisition of Dominion has almost doubled the business in terms of sales and number of stores. Dine-in sales of Dominion restaurants was significantly impacted by COVID-19 restrictions in Poland in 2020. As already mentioned, the government has restricted dine-in twice in 2020, once during the spring for 9 weeks, as well as the autumn for the last 10 weeks of 2020, and continuing in 2021 for a further 21 weeks. An impact of this is visible in revenue and system sales numbers, you can see on the slide. As you can see on 2019 numbers, Dominion has a track record of positive EBITDA, and it more than offsets the losses generated by DP Poland in 2019. Thank you.
I think the next thing is to move forward to Piotr, who's going to talk about the future rather than the history, just integration progress to date of putting these two businesses together. Piotr, over to you.
Yeah, thank you, Nick.
Maybe before Piotr starts, I would also maybe comment on how we see the synergies sort of from the shareholders' perspective, and what was the key rationale for us to get into it, and then I would hand over to Piotr to discuss how far we got, if that is okay with you.
Great.
So as I mentioned, there are two main drivers that got us into the situation where we are in, and you will hear very shortly that we are basically on track, and we do not see a reason to become less optimistic. The first is about the top line synergy and the top line growth. That can be decomposed into the increased volume. Both businesses have much better visibility, much better footprint. Dominion, with its dine-in business, is located on high streets and in very high traffic locations, which should now serve the entire network. The all delivery business is done under Domino's brand as of now. The dine-in will be done partially or temporarily under a brand called Dominion by Domino's. That is to ensure a smooth customer journey of Dominion customers, but that already promotes the brand of Domino's and contributes to the overall brand awareness. Additionally, we can already see a trend in growing the average check. Piotr will comment on this also shortly, but that was one of our clear synergies on the top line. We could see that the two businesses, although operated on the same market, served the same customer base. They had different average check size, and we can already report that this gap is narrowing, if not eliminated, between the two stores, and it's going up. And going up is a major improvement, because in delivery, the cost of delivery is fixed. It's connected with the wage, but the more revenue we get per order, every incremental euro or zloty of sales brings us much better profit margin. So that is already happening. You will hear about it shortly, but that was one of the key drivers. Thirdly, technology. We have launched a new website at the beginning of this year, and we are about to launch a new mobile application, and all of that will serve one brand. There are obvious economies of scale, not only in terms of software development, but also positioning in internet and online. We are much easier to find, and we are much more visible in internet. Lastly, customer engagement. We want to grow the business in the delivery direction, but the dine-in locations serve as an opportunity for our customers to get a better customer experience. If you take a parallel of Apple, these are like Apple shops or stores where you can touch the product, when you can see it, when you can spend nice time, but then you buy it somewhere else. So we believe that this is a transformation on the top line, and you will hear shortly that we are getting there, and we already see the first benefits of that strategy being implemented. There are also many cost savings that got us excited about this deal. These relate to procurement. As you can imagine, doubling the scale means we can buy products more optimal, which is basically cheaper. We have eliminated parallel costs related to rent of the office, to management teams, to auditors, and so on and so on. But most importantly, as I mentioned also before, the distance to our customers got shorter. We got closer to customer, and that brings us two types of benefits. First is on the customer experience and the quality of the product, and second is about the cost. As you know, even the best pizza composed of the best ingredients is not tasty if it comes cold. So by shortening the distance to customer, we can now provide much better quality product and warm, tasty pizza. In addition to that, it's not only the benefit to the client, but it's also a benefit to us, because if we pay an hourly rate to our driver, then this driver can serve more customers per hour, which means that our unit economics per delivery got much better. And then it also means that looking at competitors, our position is difficult to challenge, because no one has such a network of delivery stores in Poland, and particularly in Warsaw. So this is, I wanted to give you a snapshot or a view that was driving us when we were discussing this deal, and this is why we entered into this transaction. I will now hand over to Piotr, who will go into the details and will give us an update on the implementation, but you will hear that we are on track. Piotr, handing over to you.
On this slide, I will try to summarize many months of hard operational work related to the integration. We have built the combined menu of the best-selling items from both companies. The most important of these are the new types of pizza, but also new sizes, for example, 16-inch pizzas. The new menu items are very popular. Customers buy more products, and the average check is growing. Overall, the average check has increased by 10%. The increase of minimum order has a direct translation to the higher profit, as the cost of delivery is still fixed. We have initially anticipated cost synergies come, among others, from lower prices of raw materials, but unfortunately, the reality proved to be different. High inflation rate in Poland, almost 5%, did not allow us for reduction of supply costs, but it did allow us to increase our selling prices by circa 7%. Commissaries in DPP were built for a large scale, but than DPP had before the transaction. After the merger, both commissaries can finally work at the scale for which they were built. We have decided that commissary will now be a separate business unit that buys ingredients from third-party suppliers and sell to all stores at normal market prices. That approach helped us to better assess its contribution to the profitability and manage its performance. We have initially anticipated that the logistics will be done internally, but at the end we have decided that it is more economical to outsource that to an external company that specialize in distribution and logistics. Referring to headquarters, we have successfully integrated both teams using the best talent from both companies. We had to unify the remuneration policy, which resulted, unfortunately, in some people in headquarters leaving the organization in the last 6 months. But now we are happy to report that we have a stable and dedicated team for future. One another important thing, we have terminated the office rent of all DPP's headquarters and moved the personnel to the Dominion office, and that saved us the rent cost, but also other running costs. We cannot forget about the synergy effects in marketing. We have launched a new website, as Przemek mentioned, which with improved user experience across all devices. I want to emphasize that our website was named the site of the year 2020 by Kentico, who is our content management solution provider. We are also advanced in launching new smartphone app for placing orders. We have aligned the promotions in both concepts shortly after the merger and gradually unified the menu, which we believe is now more attractive for customer. I have to mention that due to the delay in IT integration, the benefits of the marketing synergy are not yet fully visible in the financial performance. As Przemek mentioned, one of the most significant synergy effect is delivery savings. Thanks to the increased density of Domino's Pizza stores after the integration, we will be able to reduce the delivery zones for most of the stores. A smaller delivery zone means shorter delivery time, which improves the customer experience and translate into lower delivery cost per order. We also expect a general reduction in scooter maintenance cost, as the enlarged fleet is now managed by an internal department responsible only for optimizing the scooter servicing costs. And finally, we are in the process of unifying the rules of cooperation with food delivery aggregators, who will from now on be responsible only for generating orders, while the delivery will be performed by our own staff. I also want to quickly present new franchise model. At the stage of preliminary analysis before the merger, we decided to buy out sub-franchise stores which overlapped in terms of the delivery zone with corporate stores. According to this, last year we took over 7 stores from franchisees, and this year we took over another 10 stores, including one store which was taken over last week. We currently cooperate with 4 sub-franchisees who operate 8 stores in total. Our primary focus for the coming months is improving the performance of all stores. And once the stores reach satisfactory KPIs, we will offer some of the locations to existing or new sub-franchisees. So that in a couple of years, the majority of our locations become sub-franchised stores. I know it is a long slide, but in the end, I want to say more about call center as a new internal unit in DPP. Until now, telephone orders in Domino's Pizza stores were taken directly by the store staff, while the orders at the Dominion were taken centrally by a call center. Following analysis, we decided to use the Dominion model. We expect average order to increase by approximately 3.5 Polish zloty as a result of upselling by call center operators. In addition, consolidating phone orders under one single phone number for whole country will improve marketing communication. Thank you, Nick, for this time.
Well, you can see there's, ladies and gentlemen, there's a lot of work been going on. We're halfway through the year, so we thought it might be helpful to give you a trading update of the first 5 months of the year and then talk about June itself. So, Gosia, over to you, please.
Numbers on this slide represent unaudited consolidation of the enlarged group for 5 months of 2021, so the period between January and May. As a way of introduction, I'd like to explain what systems sales stands for, because maybe not everyone knows it. It is sales of all Domino's branded stores in Poland, so both corporate and sub-franchise stores. We observed strong delivery sales performance, almost offsetting dine-in shortfall caused by lockdown. During the first 5 months of 2021, delivery sales of the enlarged group increased by 14% comparing to 2020, and by 28% compared to the same period of 2019. This is a result of the enlarged group taking advantage of growing delivery market in Poland due to dine-in restrictions applied by Polish government. The dining business is significantly impacted by restaurant shutdowns. Stores remain closed for dine-in service since the beginning of 2021 until 28 May. Dine-in revenue recognized in 2021 is almost purely relating to takeaway orders. The enlarged group takeaway sales grew of approximately 6%. Generating 8.8 million Polish zlotys of dine-in and takeaway sales in 2021. Like-for-like system sales during the 2021 are flat compared to 2020, and only 5% lower compared to 2019, so the pre-pandemic environment. And the revenue was lost due to permanent store shutdowns. We have been privileged to be able to operate during the pandemic and take pride in the enlarged group sales performance so far. Basically, the 5 months are still impacted with the lockdown. The business is operating after the merger, and it is growing. The numbers, I will say it once again, the numbers on this slide fully refer to lockdown period. That is why we would like to present post-lockdown numbers for June. I will just skip to the second slide. As I already said, COVID pandemic has highly impacted dine-in sales in Poland. The government restrictions were just removed on 14th May, allowing to serve food in summer gardens, and indoor dining was resumed on 28th May. But still some restrictions apply, as only 50% of inside tables may be occupied by customers. The business is not in its best show yet, but the delivery business is only 2% down on 2020, but the dine-in has increased. We observe 5% like-for-like growth in June, despite all the restrictions applying to dine-in. As already mentioned by Przemek and Piotr, dine-in business typically generates higher gross margin due to absence of delivery costs. Ex-Dominion dine-in stores were able to benefit from a relaxation of restrictions with 3.2 million zlotys dine-in sales generated between 28 May and 30th June. As you see, the enlarged group realized 25% like-for-like increase in dine-in sales in comparison to 2020. And at the same time, we are targeting to reach 2019 numbers, so the pre-pandemic environment, and a very good year in terms of dine-in sales in ex-Dominion stores. And we still missed 24% of like-for-like sale to 2019. The full impact of post-COVID-19 environment is not visible yet, as a large number of our customers are students who have not come back to universities in 2020, as the universities operated online classes for the whole year. Additionally, working from home is still prevalent, although most companies implement hybrid model of working, so we expect positive impact of this change soon. Piotr,
Thank you, Gosia, for your comment. I just want to add that the chart on the left is a confirmation of what I said earlier in this presentation. The 10% increase in average order just after the pulse conversion is complete shows our potential for the future. The chart on the right shows that sales potential of dine-in in the first day after the opening of Summer Gardens. As Gosia mentioned, there are still no students, no offices. Let's not forget to the tourists as well. Usually in May and June, tourists would already have been here in Poland, but they are now absent completely. Going to the last slide, to summarize, I would like to say that all the tasks related to the merger of both companies have been completed. Integration of the POOL system turned out to be the biggest challenge for us. For this reason, we have slight delay. We assume that we will see the full picture of the synergy after the holidays. The last information, but is very nice and encouraging for the entire DPP team, that we have received one of the most important awards awarded by Domino's Pizza International, called Gold Franny Award. It is a recognition of very good operational result and compliance with DPI standards, as well as appreciation of the process of merging Domino's Pizza and Pizza Dominium on the Polish market. Thank you all for your attention.
Thanks, Piotr. Mark, I think it's over to you now. That concludes our presentation. We're going to move on to Q&A, and Przemek is going to chair those.
That's fantastic. Nick, thank you very much. And thank you to the rest of the DP Poland team for presenting this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Obviously, now is probably a good time to hand back to you guys for the Q&A. Obviously, investors had the opportunity to pre-submit questions, and thank you to those investors that took time to do so, and also to those that have submitted the number of questions that have come in through today's meeting. If I could just hand back to you and ask you if you would be so kind to read out the question and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Okay, thank you, Mark. Indeed, we received some questions during the presentation. We also got some questions in advance. Some of those are very similar, so I'll try to consolidate those and we'll tackle one by one. Hopefully, we can manage to cover all of them today. There were questions related to sub-franchisees. There were a few questions about that. Piotr already, I think, addressed that, but since there were, I think, 3 or 4 questions on the same topic, then I would allow myself to comment on that as well, just to make sure that it's absolutely clear to everyone. We have upgraded the business. The work that Piotr presented, the integration, required a lot of effort that was put over the last 6 months, and the business has upgraded significantly. In order to get there, we also bought back some of the sub-franchise stores to allow us to have the liberty of redesigning delivery areas, redesigning the products, and upgrading the entire network. Our intention is that once we deliver improved performance, which will be definitely the case, the question is only by how much, and that we will see in the next months. Once we get there, our intention is to sell those stores to sub-franchisees. And that will be done in 2 ways. Firstly, to our employees, and secondly, to third parties. We have developed an HR policy where at the pinnacle, our best employees will be offered to take over our stores with our support and manage them as operators under Domino's brand. Our target is that vast majority of the network will be sub-franchised, and our share of the corporate stores will be around 20, maybe 25% or even lower. So summarizing, our goal is to have some corporate stores, but vast majority to be sub-franchised, which has a number of advantages from the capital perspective, but also efficiency perspective. We made a sort of a step back to be able to redesign the business, to upgrade it, and allow us to choose the best operators on the market. It is key that the stores are operated by the best operators, because that's the mutual benefit. So I think I tackled probably 3 or 4 questions related to the sub-franchise store, but if there are any other, then please let us know. There is another question which deals with the normalized. What would you consider a normalized pro forma EBITDA run rate in post-COVID environment? And there's also a second part of this question that I will now put on hold for a second, because it relates more to the investor relations. We reported to you the 5-month performance, which was during the lockdown, that we believe is not likely to continue. We see the growing number of cases in Western Europe. Poland comes out quite well in that context, but we conservatively assume, or we assume that we will also get another wave. However, the business is already very well prepared also to tackle that. It took us some. There's also another question about the IT integration. The systems are now fully integrated, but it took us quite some time to integrate this backend system, which also connects us to Domino's International backend system. It took longer than I anticipated, but already in July we operate as one brand in online, and that has a big advantage on the top line and the cost side. We, however, cannot yet report the run rate EBITDA. As we mentioned before, we have no reasons to question our synergy outlook that we had when doing this deal. We think all those assumptions still hold in nominal terms, but the run rate EBITDA we will see only based on July figures. And still, that is not fully post-COVID, to answer Mark, because as Piotr and Małgorzata mentioned, we still don't have our target audience in markets where we operate. Universities operate on the remote basis, so students are still in their hometowns, not in larger cities like Warsaw is the big market for us, so they are not here. Same with the offices. I'm talking to you out of our office in Warsaw, but I'm one of the few here. People still work mostly from home, and ordering pizza is also very, very common when you work out of office and stay long hours. So these customers are still not yet here. So we don't have a view on the post-COVID run rate of EBITDA, because this is not yet the environment. But we definitely see already the major improvement on the operating cost, and we see quite encouraging top-line dynamics. Gosia mentioned we divided the performance update in 5 months plus 1 month, because in June figures, you could see that despite the reopening of the dine-in, our customers on delivery business stayed with us. And this is despite all those deficiencies or restrictions that I mentioned about the students and offices. So that is quite encouraging, but it's not yet post-COVID. Piotr, there is, maybe also handing over a bit to Piotr, there is a question about the synergies. I think there are 2 questions about the synergies. If I can, maybe if I can read it. Are you seeing the cost synergies that you expected? What are the main cost synergies? Can you maybe comment on this? I think you tackled this, but the question still came. So maybe if you can.
Okay. I try to answer. We are generally in line with the expectations for synergy effects, such as new menu items, marketing synergies, new commissariats, profit center, headquarter integration, especially delivery savings, as you mentioned many times, and internal call center. The only one thing that is not delivered is savings on the purchases prices of ingredients. We have initially anticipated cost synergy to come among others from this, but the reality in Poland, especially during and post-pandemic, proved to be different. High inflation rate did not allow for reduction of supply cost, but we found an alternative. First of all, by increasing our selling prices by, as I mentioned, 5-7%, and secondly, by increasing minimum order value for free delivery from 29 to 33 Polish zloty. The overall effect should be the same. I want to mention that we continue to monitor market for new potential suppliers to ensure that we are purchasing products at the best market prices. We have remembered that each suppliers needs to meet Domino's international standard and be approved by DPI, which we successfully done on multiple occasions during the merger. So it's only a matter of time before we find alternative sources of supply with more attractive prices.
Sure. I got a message that the chat is disabled, but I see Q&A is open. So if people have questions, you can ask them through Q&A. I imagine.
That's correct, indeed. So the chat function is disabled, but please do submit questions. Just type the question in the box and press send, and that will come through to the presenters.
Thank you. So moving on, I see a question about the IT systems and about the percentage of online orders that we see nowadays and how that compares to the past. Gosia, maybe that's this is something you can comment on.
Repeat.
The percent of online orders for delivery, because in the past, there were also some orders, especially for Dominium, done through the call center. So can you comment on the about the percentages?
Yes, of course. As the IT integration has just finished early July, and this allowed us to use perfect Domino's website, which, as Piotr already mentioned, has won the Best Website Award of 2020. Basically, before the IT integration, the split of sales channels for ex-Dominium stores was slightly different than original Domino's stores, because in ex-Dominium stores, almost half of the orders were placed through call center. And the usage of website was approximately 30%. This is in contrary to original Domino's stores, which almost 70% of orders goes through the website. And as I mentioned, the website is really good, and after finishing the IT integration, we do expect that the level of orders done through website should be on approximately between 50 to 60%. And we also expect the application for smartphones and mobile devices to become more significant sales channel.
Okay, thank you. I had a problem with unmuting. There is also a question about the components of the 10% growth in average check. What are the main drivers? But I will give now. I'll ask Piotr maybe to comment on that. But Piotr, remember that also our competitors may be watching this, so don't give them hints. Just mention in high level why we see the 10% growth.
Thanks to our combined menu, thanks to new menu items such as salads, such as sauces, new sauces extra paid, such as new size of 16-inch pizza with there is no exist before our merger. I think that is more important things referring to this 10%.
Thank you. I will try to tackle some of the questions that were raised in advance, and then I will go back to the questions that were raised during the meeting, so that people who did spend some time before us sort of rewarded for this. So there are some questions related to the investor relations, and they also sort of are repeated today. One is there was a question related to, just a second, I will need to open it. Yeah. There is a question about what, I will read it loud, what further steps can the company take to improve their message to the market? And there are also some other questions related to that, so I'll try to tackle them all together. We are in a very sort of strange environment, and also the situation of the company is also a bit extraordinary, because the two businesses have merged, and it's quite difficult for us to present you with the data that you are used to see in other businesses. That is what we are doing our best, but indeed this situation is quite unprecedented. This is why when we presented you with some statistics, we compare ourselves to 2020 and 2029, because on one hand we need to benchmark ourselves to the latest performance, but on the other hand we understand that 2020 is a bit untypical. What we intend to do is also to accelerate or to intensify communication with our shareholders, and at least on the quarterly basis, we will be presenting you trading updates. We understand that, as I mentioned at the beginning, we understand and we feel the same, that the 2020 performance is not really relevant because it's pre-merger and it's also during the COVID. So it doesn't give a really true, it gives from the accounting perspective a true and fair view of the business, but from the business perspective, this is outdated. Furthermore, I would even say that the last 5 months data is also quite outdated from the business perspective, because the business in its final shape, in the run rate, as one of you asked, we can observe only now. So in order not to delay too much delivery of the information that we believe will be positive, because we can already see the hints of that, we want to intensify our reporting and come back to you at least quarterly with more details on the performance and run rates in particular. There was a question related also to some research reports. I'll try to find it. about improving analyst coverage, not only working with N+1 as a broker. Maybe on that, Nick could comment on what was the past practice, and then what is our plan going forward.
Yeah, with pleasure. Thanks, Przemek. I can't actually see the question. Can you give me a clue of what time it was so I can get it specifically?
Nick, that was a pre-submitted question. It reads as follows: what plans do DPP have to improve analyst coverage with just N+1 Singer covering them as their corporate broker?
Okay, thanks very much. Right, well, the short answer is that as a lot of ladies and gentlemen following this will know, smaller companies tend very often just to have the house broker. There's been a great deal going on. We're delighted to have Singers on board, who came on board a little while back and were helpful in making the deal happen. We are hopeful that Singers will publish research fairly shortly when travel restrictions are lightened, so that the Singers analysts will get across. Now, I'm aware that if you're not a client of Singers, to get access to that research, courtesy of MiFID II, is difficult. In the past, DPP has used Hardman to publish paid-for research, which the public can access, and that is something we will look at. But right now, there's still a lot on our table to be dealt with, and also it's an additional cost, and we're very cautious right now about keeping our cash under close control. So I think in the short term, we've got Singers, for those who can access it, a Singers research note before too long, I hope, and from the company, quarterly updates. The next one obviously being the results of 30th of June, which we're going to have to start working on we are already indeed. So I think that's all I can say at this point.
Yeah, thank you, Nick. There are also a few questions related to the liquidity of the stock and also potential dual listing of Domino's Pizza Poland. So I think I'll try to answer those at the same time. We do not plan dual listing at the moment. We also know that the liquidity is low, but we want to basically show a momentum to the market. As I mentioned a few times already, we have spent a lot of time on being very lean operationally, improve the performance, and this was our primary focus. We will consider improvement of investor relations and also other activities in the second half of the year, but we do not have plans to go for the dual listing. It is still anyway quite burdensome and expensive to keep the listed entity. So dual listing, I think it's still a small entity. Also to address some other question. Moving on, also addressing a question that also came out today. We do not plan any capital raises in the second half of the year. We feel we are fully funded. We have completed the integration by now. This was done in line with the budget, although with some delay. So indeed, we anticipated to have a higher cash position as of now, because then the integration, if completed earlier, it would benefit us earlier. But we are fine with what we have. The cash balance is sufficient and satisfactory, and we do not plan any capital raisings going forward. Well, with at least within the next 6 months. If we are to, maybe this is also, there is also a question about the new stores from Mark. Do we still plan to open 5 stores this year and around 10 next year? I think it's probably fair to say that we have just opened 1 store last week. We will. There was also another question, and I will try to tackle those at the same time. There was a question about the size of the business we envisage, and then I will say this as a representative for the shareholders, so then you don't chase Piotr for that going forward. But we see that there is a space on the market to grow the network by a couple of times, but within the next probably 3-4 years, we would like to see the network doubling as the shareholders. We see there is more space for Domino's. We are the leaders in delivery business, and the new openings we would do still in the places where we are dominant in position, just to decrease the delivery cost, but also in the other smaller cities and towns where we would take the pole position. So we see much more space. When you take the per capita store penetration, we have space to grow. When you compare us with UK or with other markets, I think there was a Domino's Pizza Enterprises report, I think 2 years ago, that shows some statistics of their expectation of the market. So we intend to double probably within the next 3 to 4 years. We expect that this will be financed with the operating cash flows, but also with some senior debt. You may see that the company today is almost debt free from the lender's perspective, from the senior lender's perspective. There is a loan that is a shareholder loan that prevailed the transactions. It's a loan from us as the shareholders. But there's no bank funding, and we intend to use bank funding to accelerate growth of the business in the following years. I think we were in touch with some of the shareholders, and I represent the larger shareholders. We don't want to be diluted. We see the value of the business going forward, and we would like to use cheaper sources of capital, and senior debt is, especially these days, very easily accessible and cheap. We will be able to access it once we deliver the performance post-conversion. That's quite key. We are already in talks with banks, but we want to show them how we operate in the third quarter, and based on that, we will be able to kind of advance in those discussions about additional funding. There is a question about well, I'm now going. I think we can allow ourselves to extend this session. It's fine with us. It is important for us so that you have full visibility. So apologies for some of you that have not got answers to these questions within an hour, but we'll continue for another 15-20 minutes, and we'll try to address as many as possible. So reading the question about the there's a question about how do you see the pizza market in Poland developing? There has been talk about Telepizza willingness to exit. Would you be interested in this? I'm thinking what should I say, but I would say yes, that because we have signed some non-disclosure agreements, so we are not that free to talk. But basically, I think this comment is correct. I think Telepizza is probably willing to exit. But from my perspective, we feel we got the machine right. So as of today, our Domino's Pizza Poland machine is well functioning, and we think we can expand organically. We will be looking at acquisitions opportunistically. We, as a fund, we are used to it. We do M&A. However, looking at the the business model, we feel Domino's is superior to that of Telepizza. We have equipment that was upgraded to meet the high standards of Domino's International. This is high standard in terms of hygiene, but I mean, I think that standards are probably met by all participants. You cannot get away with something that does not do that. But in terms of the efficiency of the production, in terms of efficiency of the systems, we feel that Domino's is in a pole position, and we can win the market share without acquisitions, although we would be looking at those opportunistically. So that is to address the question from Stephen. There is another question from Stephen about the target sales and EBITDA in terms of percentages and millions of sales. We do not have an intention to give any guidance on 2021 figures for that. As I said, we do anticipate a significant improvement going forward. The first half year is still affected by pandemic and still not showing full potential, but starting from July, we anticipate it to be significantly improved, but we do not intend to publish any guidance. Then another similar question like that coming from James. No, we do not intend to present unadjusted positive profit. And again, question from James about the expected IT system integration to be completed. It was just completed, I think on the previous Friday. Now we operate, if you order pizza in Poland from Dominium, you will be redirected to Domino's. You get it from Domino's in the branded scooters. We have paid a lot of attention to meet the standards or even exceed the standards of Domino's International. So it's all completed now. We see we start to see already the benefits, but it's too early to share statistics because we need to see more than few days or weeks. Then the question, I see Stephen is active. When would you expect Fund 3 to be in the realization mode? We are not in a rush as investors. We want to maximize the value. That's the key element for us. We are getting momentum. We are not in a rush. We are also subject to lock-in agreements and restrictions, so we are not in a rush. We don't anticipate to go for it now. But of course, we are a financial investor. We invest with the prospect of exit, and it's not a surprising probably statement that we intend to make money. So we will be striving to maximize the valuation of this business. And we see some reasons to believe that this will be the case. What happens to the question from Charles? What has happened to cash balances since the merger? I cannot comment on very detail because I guess this would give this would probably breach the restrictions regarding the RNS, because we can talk here about the numbers that were already part of RNS. I can only say that cash balances are satisfactory, and we do not intend to raise more money. And another question coming from Peter about the bolt-on acquisitions for the group in Poland. When do we expect the COVID restriction to be lifted? Zero restrictions. It is gradually happening. It's still not fully the case. So there are still some restrictions that apply to dine-in. But the most important element is now no longer regarding the restrictions, but it is regarding the customer behavior and also our target audience. As we mentioned already before, but I will repeat this to answer this question. Some of our customers are not in markets where we operate. So students who stay with their families and they do not, they typically would buy our pizza, but they stay with families and they don't do it because they are in smaller towns. And secondly, offices. Still, people work a lot from home, and when we sort of talk around, it seems, it's clear that people are gradually going back to the office. As I said, I'm participating out of the office. Piotr is in the office as well. But Gosia is on holidays. So still the offices are not full. And we think that probably only in October we will see the situation coming back to normal. So we'll see more people back in big cities where we operate. I would use this occasion also to say that with the business model that we currently have, I would say that we are also quite well prepared for any potential additional lockdowns. We think that there will be next waves probably of COVID, which is unfortunate, but we do not really anticipate lockdowns. But even if those take place, we think we're well positioned. We now operate a fully integrated business with strong e-commerce, with good pricing, improved pricing. We have fine-tuned or sort of squeezed out the margin out of also our suppliers. It's also probably fair to say that we had, I will not comment on the brands, but we changed the soft drink supplier and we got much better deal out of that. So if there is additional, so that there are further waves of COVID, we will be able to sell more pizza on delivery, which we demonstrated we are able to do. And you can see this on the 5 months performance, that even during the COVID days, we have accelerated growth compared to 2020. This is the strength of the combined business. However, if miraculously the COVID comes to an end, then we see already that also people will be more willing to enjoy dine-in, and our dine-in part of the business in Dominion will cater for that. As you could see on the previous slides, even though the dine-in was open, the delivery was holding up, but then customers or tourists coming or moving around will enjoy our dine-in.
I don't know whether it's a good time just to cut in and give you a small rest. Obviously, we're mindful of your time, and obviously, for every question you answer, there seems to be another one or two that come. But obviously, we can make these available to you post the meeting to enable you time to reflect on some of these. I don't know whether there's any more perhaps that you want to just pick up on, or perhaps I can hand back to Nick to wrap up on a final comment, and then I know investor feedback's important, and I can divert investors to provide that for you.
Thank you very much. Shall I go on from here? Very simply, ladies and gentlemen, thank you very much for making the time. We very much appreciate it. You know, this is a deal, a transaction, an integration that we're very excited about. We think there are some great prospects, which we will look forward to telling you more about in the coming months. But thank you for your attention. We'll do our best for your company.
That's great, Nick, and to the whole of the management team from DP Poland, thank you very much indeed for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of DP Poland, I'd like to thank you very much indeed for attending today's presentation. That now concludes today's session, and good afternoon to you all.
Thank you.